You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to the show, Bob.
Jim, good to be with you.
Interesting times on the Asian stock markets?
Oh, my gosh. Yeah, well, it was kind of dull earlier. That would be either Shanghai or Hong Kong earlier in the year, and then all of a sudden, boom, up it moved. A tremendous rally in their main indexes, and then on top of that, you had them in Shanghai opening, I think what it was is 1.5 million accounts a week, opening new brokerage accounts. So it was all froth stuff and new issues coming out and going to horrendous premiums, doubling, tripling, and then a few days ago they announced one, and I can't remember, but it was a big size company, big cap company, and it fell 60% in one day. So the guy that was a 2 billionaire is now only a 1 billionaire. But then how can you be sure of that? Because that kind of a sell-off prompted my suspicion that maybe some insiders there were highly leveraged on their own deal. Who knows? We'll see what the wreckage brings over the next little while. And then you've got here the U.S. market, another legs up, but only were like the S&P and the Dow. Some other indexes were not making new highs. The Russell 2000, which had been a leader earlier in the year. And what we're looking at, and beginning in, it was Valentine's Day in February, that we looked at the old, let's even maybe call it the venerable Dow theory, which has been around since since about 1900. Where researchers and Dow, followed by a guy named Hamilton, they looked at it and said, here's an indicator, is that you've got a bull market when the Dow Industrials, and in those days the Dow Rails, were making new highs together and correcting together and then going on and making new highs. But then there would be indication of cyclical change when the transports, as we now call them, no longer confirm the new highs in the Dow. So that goes back to December, where they both had new highs. And then in March, February into March, we looked at it, and it had then about 6 weeks of non-confirmation by the transport. And looking back on the old theory and how it works is that we realized that if you went for a non-confirmation for 6 weeks or so, you would have a modest correction. But if the non-confirmation ran for longer, it would be a bigger correction. And the Dow made new highs just a few trading days ago. Meanwhile, the transports were actually in a steep decline, particularly in the last month here. Technically weak. Each of the rallies were coming up and touching the 50-day moving average and failing. And then now here, as of this morning, new lows for the year. So what we figure here is that we're watching the Dow to see if it will do the first step, which would be to slip below the 50-day moving average, and it has a couple of hundred points to go before that. But the action was down at the opening here, generally recovered a little and then drifting lower, with, as I said, the transports making new lows. But then also on Tuesday, all of a sudden, I didn't see any news with it, but you had the airlines extremely weak, with LUV dropping 10%, and United Airlines dropping 9% on the day, which is a distinctive drop. So, of course, that they're in the transports index, so that helped that go down. So we're looking at an indicator here that is giving an alert, and way we're looking at it now, if the Dow drifts below the 50-day moving average, then that's a first step in following where the transports have gone now. The other thing is here is the interest rates. We've had, of course, junk collapsed with the collapse in crude oil down to January, and then the junk bonds rallied with some big swings. But since March, the rally in the junk bonds we figure is a seasonal one, because oftentimes if you have a good rally in lower grade bonds going into May, June, you can get a very good reversal on them, and that's what set up the problems last year. Was the junk bonds reversed in June. So with the favorable action in junks, some credit spreads have been narrowing, and that's part of the fun into May, June. And we'll look at the credit spreads here, U.S. corporate credit spreads. If they turn around here and start to widen, this would be a warning on a possible credit distress in the fall. Now, the one that was not giving any warnings last year on the credit department was the yield curve, which is the difference between interest rates paid for long-dated stuff and paid for short-dated. And it has that when you're well, we're calling it a boom. I mean, the economy's not been that strong, but the financial markets have been very strong. So let's just call it a boom. So in the past, and we used this in 2000 and 2007, the curve flattens, long rates rising faster than short, and it can flatten for 12 to 16 months against the boom. So we had the count going, and March was the 15th month, and the flattening stopped, and it's now technically reversed to steepening. So this is the first on this business cycle and credit cycle for this event, and as I said, it really worked well for us in 2007, 2000, and actually back in 1998 when the reversal in credit spread set up the failure of long-term capital management, which was exciting then. Oh yeah, that then becomes a little subset itself, whereby long-term capital management was highly leveraged fund, I think about $4 billion, which was good size in those days. And the whole structure of it was so confident that even the senior central banks loaned money directly to the hedge fund, and the bank an equity position in it. So then when it failed in that August, September, October, there was a huge scramble for all of the central banks to get their money back. So then what you have now is the senior central banks, European Central Bank, and the Federal Reserve have been buying bonds. They've not noted for selling any, so they're become their own hedge funds. And then we've read that some of the central banks have been buying equities. And this is not like for their employees' pension funds, but this is for their reserves. And the one a couple of weeks ago was the Swiss central bank had bought quite impressively. So the senior central banks have become highly leveraged hedge funds. So I don't see where they have any more skills than the guys did at the long-term capital management when the seasonal turn to widening credit spreads did them in. So here we are now. We're poised for the next seasonal turn to widening credit spreads, and we'll see what happened. But back in early in the middle of January, we started going on that the rise, then the rally in bonds, both European and particularly the German, and U.S. Treasuries was becoming sensational, and described it as looking like ending action. And so later in that month of January, we got the upside exhaustion readings on the long U.S. Treasury bond, and say this is a major top, and you would have quite a sell-off in bond prices or rising interest rates. And the other part with that was that it would eventually get the European bond market, and that went on until it was April 17th when the yield and the German 10-year note got down to like 0.06. It was totally absurd. And then it's reversed. It's gone to 0.7, which is a huge change. And it reminded of when in 1992 George Soros was making money shorting various currencies, and then got to the sterling and was short that, and the Bank of England was trying desperately to hold it, and then it cracked, and that was it was reported to make $2 billion on that trade. So here you are, you have an instrument, a 10-year note bid by the European Central Bank down to an absurd level. That was April 17th or 18th, and then it's reversed. So I imagine if there were some big hedge funds in that one on the short trade, in which case they've made a lot of money, because the way you look at it is that those absurd low interest rates and the reversal, it effectively canceled something like 25 years of income. But we look at it and took it back to the interest rate levels in November, so it took 3 or 4 weeks to undo, 5 months of bull market. So this is major, and it's had a weak correction in the last couple of weeks. But the next rise in German rates will be very interesting, and the further steepening of the U.S. Treasury curve. The steepening helps balance sheets of commercial banks. But in this case, steepening is also saying that deflation is just around the corner, deflation of financial assets, so that will be quite awkward. So then we can move along to gold and silver, which did get a rally out of December, a sharp one, and then back to a correction into March. And then we had our rotation where a number of commodities could rally from depressed levels earlier in the year out until around May. Crude oil made it, became overbought. Base metals had a good rally. Going back to the crude oil stocks had a good rally, and then you had base metals had a nice rally, and the base metal mining stocks had a nice rally. Well, all of these became overbought in May on our target, and we advised lighting up on those things. So perhaps for commodities, the best is in now, and in which case, after mid-year, with changes in the credit markets, they could be weak. And then one other item here is that the U.S. dollar, which had become super overbought in January, then sold off and became quite oversold at resistance at 93 on the DX, and it's turning around and rallying, and that is not going to be convenient for speculators in commodities or the precious metals. So we hope for very good weather during the summer, because maybe the financial markets will be bleak.
We'll have more with Bob Hoye right after this.
More and more people are looking to the Internet for intelligent, riveting, and thought-provoking interviews. To advertise on The Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with market historian Bob Hoye. A couple of questions from overseas. First of all, Dave in the UK asks, are we getting close to the equivalent of 1720 when the central planners are all in on the bubble as per the Mississippi and South Sea bubbles? Well, Bob, what was going on in 1720?
Well, these were fabulous financial bubbles, and the setup was the end of rampant price inflation in 1711, a flat economy, and then in England, let's just stay with that one, the government figured out a way to surrender and reduce its debt by, they had a quasi-government company called the South Sea Company. So they set up all kinds of wizards there where it was buying the debt at the par value, and they were trading at a huge discount. In turn, they were selling the stock plus warrants and options to the public. It became the first bubble. But the interesting thing was that as it was cresting, those participants at the time described it as a bubble. Whereas our own experience in 2000 and 2007 was that the head of the Federal Reserve said, well, you can't tell if it's a bubble until it's over. I mean, these guys are just so thick. But at any rate, the bubble brewed up, and in, I think it was April of 1720 in England, they found that they were having trouble flogging their paper because there were so many other bubble stocks being floated. I think it was more than 400 that year. So then they came in with the Bubble Act to prevent new issues of bubble stocks, thinking that all the money then would keep bidding up the South Sea Company. And it did until that June. And that was the high, £1,200, I think, was the high trade. And it went, corrected and churned around during the summer, and then beginning in September went south and it went all the way down to £120. It was a real disaster. Within it, there's an instruction is that in England, they were on a bimetallic standard, and so the pound was, you could say, sound, and the bubble was done with credit because the Bank of England was lending money, say 5.5%, and you had the equivalent of call money up at 20%, so everybody was making money. And in Paris, the Mississippi company there was the focus of a bubble. And John Law was the first truly reckless he was a central banker, and he had imposed a paper money system that he said was better than a gold coinage, a silver coinage system. And he had, I think it was 8 printing presses going in Paris, printing banknotes that, of course, were being used to bid up stock prices. And then when the stock market crashed, the whole thing was a disaster. Law was lucky to escape with his life. But the public had to see that the plates of the currency printing presses were destroyed. So here you have, in England, endless credit for the bubble, it crashed. And in Paris, endless printing, and the bubble blew up and crashed. So there's, here. So this is where now, when this one is ready to roll over, it will. And thanks for the question, Dave.
Well, it really does sound like the setup we have right now with quantitative easing.
Oh, yeah, it's the same.
And they haven't learned anything since 1720.
Yep, nothing has changed. Also remember that the high for the South Sea bubble was in June. And what's the date now?
A few ticks away from June.
Yep.
Our second question is from our buddy in the Netherlands, Bert Venkenbach. And Bert wants to know, what are the chances that gold will be confiscated again? I know that gold is not part of the monetary system at this moment, but when the apparatchiks try to abandon cash, and I think they will, gold could become an interesting cash alternative again. Well, are they going to take away our gold, Bob?
Well, I imagine they would think of it, but this was one of the issues of the planning classes in the early 1930s with that contraction, is that people were hoarding cash to protect themselves. And then they had the anti-hoarding movement, government agencies on it, and they put signs in merchants' windows and all, against hoarding. But here now in the last few weeks, there's been articles written by economists about this may be the resort, that they want to go to a completely cashless society. And their frustration, of course, is that while they're humping the money supply like mad, the velocity of M2 has been contracting steadily, and this, of course, is defying their plans. And well, I guess it's either take everybody's cash or make sure that everybody has at least 1 or 2 courses from Economics 101, so they then will follow the instructions of the central bankers. But to be honest about this, for Bert, I don't think they'll do it. I think that this forthcoming collapse, the average person in North America and perhaps Europe will look and say they made a huge heroic effort. They bought all the bonds. They've risked our taxpayers' money. They've killed the economy. No more. So I think this is the one where reckless central banking will be condemned and will be isolated and made going to a sound central banking. So there'll be many who will think that they can make their theories work by confiscating gold, but I don't think it'll happen.
Well, what about confiscating cash? They did that in Cyprus.
Yeah, no, I think you're at the crux of a major political change whereby the folks say enough. And that was the case in the early 1600s, where you had a century of chronic price inflation, and England is the best example, and chronic authoritarian government. I've called it an experiment in authoritarian government. And finally the folks said enough. And it took 100 years before they got rid of the last, well, not fully, that was 1672 when they got rid of 1688 with the Glorious Revolution. They got rid of the last absolutist king in England and went on a path through history of remarkable freedom. So, no, I think the crisis coming will reinforce the view that governments are idiots and I think it'll be very exciting times. Also, Jim, I think it's a privilege to be an observant and a participant in this segment of financial history where you've seen such reckless ambition by the state, and we will soon see the consequences of that reckless ambition, which will be severe deflation.
And whoever's in power at the time, will they get reelected?
They'll get hammered. They will receive a great displeasure.
So if this happens before October 19th, Mr. Harper could pay the price.
No, Mr. Harper is on the side that's been trying to limit the experiment in authoritarian government, and I think he will be, I think he'll win the election.
My guest has been market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Their website, institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Check out our popular YouTube channel, Talk Digital Network. Comments or questions for the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.